In our strategy, we focus on how money moves through systems. We're not forecasting headlines. We're tracking pressure, sequencing, and constraints as regimes shift. The quietest bond market on Earth just sent a signal, not a crash call, but a pressure point that rarely moves without consequences. We're reviewing economic cycles and their video on Japan's bond market shift. They focus on plumbing and regime change. Our role is to map that signal into our strategy framework. Japan's long-term government bond yields are rising, levels not seen since the late 1990s. That alone gets attention in a market trained to ignore risk. Yields are rising, but the yen is still weak. That's not a healthy tightening signal. It tells us real rates remain under pressure. The yield gap with the US is still wide, but markets don't fear the level. They fear the direction and what it breaks. In December, the Bank of Japan nudged rates higher. It sounded small, but it broke the promise of permanently free money. For decades, Japan trained markets to ignore duration risk. Cheap borrowing became structural. Now that conditioning is reversing. There's a popular narrative. Higher Japanese yields force money home. Reality is messier. Hedges, liabilities, and risk limits slow that process. The BOJ used to absorb supply. When demand fell, it stepped in. Now that backstop is fading. This isn't a slow adjustment. It's repricing, and repricing tightens financial conditions faster than expected. Japan's debt load is enormous. When rates rise, servicing costs rise immediately. That creates internal competition for funding. Markets aren't just pricing policy. They're pricing constraint. That's fiscal dominance risk. Quick note, this is educational macro analysis only, not financial advice. It rarely begins with default. It starts with yields rising, then currency pressure, then refinancing stress. Allow yields to rise and expose the budget, or cap yields and risk the currency. Either path has a cost. Japan isn't just a borrower. It's a major holder of U.S. treasuries. That's a transmission line. Those positions don't trade quickly. They move only when pressure forces them. That's what markets watch. Rising long-term yields reprice everything. Equities, credit, valuations, that's the transmission. A stronger dollar in stress isn't confidence. It's scarcity. It signals tightening plumbing. January matters. U.S. CPI, the BOJ meeting, then the Fed. Policy, inflation, and supply can turn together. That's when moves accelerate. Not because of panic, because of mechanics. Long JGB yields holding higher. Yen weakness despite rising yields. Rising hedging costs globally. It raises sensitivity to duration shocks. It tightens the margin for error. It shortens reaction windows. It doesn't force immediate liquidation. It doesn't guarantee crisis. It doesn't remove the need for confirmation. Japan didn't pull a trigger with words. It changed the path of money, and when money changes direction, markets reprice. We don't need to be early. We just can't afford to be late.